closes. You got one, two, three. You got like three good closes, maybe one bad close and one medium close. So the closes are better on balance. But then you drift back here. So you drift back over, I don't know, 1, 2, 3, 4, 5, 6, 7, 8, maybe 10 weeks. You drift back, you come right back to the breakout, which will happen. Look at the tennis ball action in 1 week and look at the volume. Look at the contrast in volume and the contrast in price. This is the largest week up since it broke out, and it just comes ripping back and then just off to the races there. That's what told you that, this stock had that again, Bill Berger, tennis ball. You have a tennis ball or an egg. This is a tennis ball. It came bouncing back. So question is, what do all the previous examples that I just showed, what do they all have in common? The first thing is that every one of them were immediately profitable. And this is what you now, it doesn't mean you sell a stock if it's not immediately profitable, but it is a red flag. If it doesn't break out and within a day or so it's not profitable, well, you have to start thinking about maybe or entertaining the idea that maybe I'm early here. Maybe it's premature. Maybe I made a mistake in timing. So then you look for follow through buying. Okay, it doesn't immediately move, but it should within a number of days, certainly within a couple weeks. The first week or two is sort of that window where the rubber meets the road, and I'm really watching carefully. So I want to see if it's not profitable immediately. I want to see some follow through buying. Day 3, 4, 5 down the road. So then as we get down the road and we go a week or two, I'm going to start counting how many up days versus down days and up weeks versus down weeks. And I want to see more up weeks than down weeks, more up days than down days, because obviously you're not going to even have weeks in the first week. It's only going to be 1 week. So you're going to count the days first. Also, as Mark said, the closes. How many good closes versus bad closes? Is there tennis ball action? When stock pulled back, did it recover and get back into new high ground? Are there good volume characteristics? Are we getting high volume on the rallies and low volume on the pullbacks where you're seeing that contrast? And also, how quickly are we having begrudging pullbacks and explosive rallies, or is it just the opposite? Are we having you're having rallies that are begrudgingly, and then the stocks was crashing down? That's the opposite of what you want to see. So, all right. So these are the main things that you want to look for. And I'll tell you right now, I've been trading for 40 years, and this analysis post breakout encompasses like 90% of what I'm looking for. This is really pretty much it. It's very straightforward and basic, but super powerful. And I can assure you that very few people are doing this and looking at stock breakouts with this type of analysis or this type of gauging. This is simply just gauging. We talk about maybe, Mark too, we need to talk about feedback. We're constantly gathering feedback. We're form the basis of buying the stocks based on the stock setting up. But once these stocks emerge and we buy these stocks, we're wrong just as often as we're right. We take losses just as much as we take profits. The difference is we manage the losses in relation to the gains, so the losses are much smaller. We create that asymmetric leverage. But we have to have some way to ascertain whether things are acting normal or they're acting abnormal. And this is the way I do it. And again, excuse me, it seems like it's basic, but it's extremely powerful, and very few people are good at doing this. This is
and I would just add, the longer you do it, and this is, we talk about this a lot, right? There's the science side and the art side. And the more you properly apply sort of the non-negotiable criteria, the scientific, elements, the things that can be quantified, the better you'll become as an actual practitioner or an artist, if you will. And just an example that I was thinking of, though, this was probably 3 or 4 months ago. We were playing a few stocks off the lows, maybe midsummer, I can't remember. And one of the names really looked good, blasted off. And then it had a really bad close a day or two later. And we were in a Q&A session, and I think we both, but I remember saying, like, this stock is not acting right. and you said no, if this was a key leader, it shouldn't be behaving this way. And then sure enough, 2 days later, the stock just imploded and got absolutely crushed. And somebody, then asked us the following week, well, how did you know? We didn't know. We just knew. We didn't know it was going to get absolutely murdered. We just knew it was not acting right. And, again, to David Ryan's example of if you're looking at the perfect bills, you're going to see a true stock that is really under institutional accumulation is, to Mark's point, it's not going to have bad closes, certainly right off the hop, because the institutions they're scrambling to get a position. So they're not going to sit there and then dump it on the market. And to your point earlier from, the video, I thought was great in terms of, we saw that again and again as a theme through the latter part of 2021. Well, then it was no surprise when the entire market rolls over, the institutions were net sellers, and they still are today. So yeah, I can't emphasize enough. No, not very few are doing this, and even fewer are doing it well or put in the time to really become an expert in how to use this analysis properly.
So not only are 98% of the biggest winning stocks in history in a stage 2 uptrend, and 99% of them are above their 200-day during that period, virtually every single one of those big winners, when they broke out of those VCPs and those bases, had these characteristics, all these characteristics. Almost every single one. You go back, you look, they're either profitable immediately, or there's follow-through buying very soon after they break out. There's more up days than down days. There's more good closes than bad closes. There's tennis ball action. They begrudgingly pull back. They explosively take off. Then there's good volume characteristics virtually every single time. So again, demanding that you have this tells you that those are the stocks that you want to hold. Those are giving you the criteria of the biggest winners, and you might have a big winner in your hands. But like I said before, if you go with stocks in downtrends and your stock is acting the opposite of this, well, you're not in the 99, 98% club anymore. You don't have that 99% probability. You have a 1 or 2% probability. And while it could work, the probabilities are going to be a lot less. So let's talk about when those probabilities go south, because now we talked about what you want to see. Let's look at what you don't want to see. And again, I'm not suggesting that you sell the stock and you don't allow it to stop you out. You should, before you even enter a trade, you should already know how much you're going to risk, and you have that stop loss set. However, if I get a lot of violations starting to pile up, I sometimes will sell the stock even before it hits the stop, and very often I'll at least cut it back. If I got a lot of violations, the stock's really acting poorly, I'll almost always cut the position in half, and I'll take some off, and then if it stops me out, I have a smaller loss because there's some writing on the walls. Now, sometimes the stock is at a decent gain. It runs up real fast, a day or two, and then it starts to act poorly, and I'm still at a profit. There's times where I'll even take, I'm just going to take a small profit here. It's not acting right, and if it shapes up, maybe I'll go back in it, see if maybe I can get another buy point at some point, and I'll just step aside, or I'll just take some off, and then I'll put the capital that I took off of that, the partial, maybe I take off half, and I put that into another position, and I buy a half position somewhere else of a stock, or force feed one of the stocks that's acting better, and buy more of that one if it's still in a base, maybe coming through a second pivot, and then I'll use force displacement and force feed another one. So again, I know that's a lot, but let's take a look at the bear signals now. So low volume out, high volume in is one where, and I'm going to show you a few examples here. That's when the stock breaks out, and either there's low volume where you don't get much volume, or when the stock comes back in the base, okay, it comes back in, it undercuts the breakout, comes back into the base, you're probably at a loss. The volume is higher than the volume that it came out on. So even though it came out on high volume, the volume coming back in is even higher. That's not a good sign. That's not what you want to see when a stock breaks out. Also, I look for how many consecutive lower lows are made. And the reason why is that when a stock is under accumulation from institutions, what they normally do, if the stock starts moving, they'll back away from it, because now they're starting to defeat the purpose of getting the stock at the price that they want. They start buying it at 100, and now it runs up to 105, 110. They don't want to chase it up, so they back off. And now as the stock pulls back, they'll go in there and they'll start adding to the position, and they support it on the pullbacks. So you want to watch if you have supportive action, because institutions will generally buy on 2 to 4 days down. As it comes back for a couple of days, that's where they'll step back up to the plate. And at that third or fourth day, you want to start watching if you get support. Lower lows, you get 3 lower lows, you start watching 4 lower lows. At that point, you want to see support. Now, let's say you get 5 lower lows, and then 6 lower lows, and 7 lower lows. Now that's acting abnormal. Every lower low after 4 lower lows, in my experience, and all the stocks, the thousands of stocks that we've studied, the probability lowers. And if those lower lows now there's closes below the 20-day or the 50-day moving average right after a breakout, not anytime, I'm talking about just right after a breakout coming out of a VCP. If you're below the 20, you're below the 50, and you've got the lower lows, and you got low volume out, high volume in, and you start to have all those pile up, your probability of that trade working out, the probability that you have a big winner, plummets. It goes way down. More now, just like on the upside, more bad closes than good closes, as opposed to more good closes than bad closes, is a negative sign. So you're going to count how many good closes, how many days up versus down days, and do the exact same analysis. Only if you get the reverse, that's not good. So let me show you some examples. So lumber liquidators, I showed you when I was buying it, and it was a market leader, and we got that leverage, right? It took off and it made a big move. But then later on, in December of 2013, this stock came out of a faulty base that wasn't the greatest VCP, and it tried to come out of that base, and then very quickly came right back in. Look how big the volume is coming back in. First of all, the volume coming out there was hardly any volume to begin with. So it wasn't a very successful breakout. But then this big, giant amount of volume brings the stock back in. And then, of course, it comes in, it has a huge sell-off, and it gets below the 20 and the 50-day. If you already stopped out, certainly that should have got you out. But now the probability just plummets, and this stock topped right here. This was the end, and it was a disaster after that. Here's another one. OUTR was the symbol. Pretty tight here, right? Tries to come out, and now you can see the volume is higher. It comes out on low volume, but then when it comes back in, the volume picks up. That's a negative sign. Now, these will also sort of pile up. A lot of times you'll get multiple readings or multiple signals at the same time, where now, okay, it comes down on higher volume, and it might be your third lower low and close below the 20-day. Now you've got 3 violations. So the rule of thumb is that, one violation may not be where you hit the bid and you run out, but as the violations start piling up, the probability is getting less and less, and you might want to start reducing or get ready to sell that stock and be prepared that it may hit your stop. So again, here you go, 1, 2, 3 lower lows, right? Close below the 20-day line. Now, 4th lower low, 5th lower low, 6th lower low, right? Dead cat bounce, and then it just starts selling off here. This fell apart too. Again, was just not acting right. Go look at another one. So here you got a full retracement. That's another thing you can look for. If you get a decent little gain, the stock runs up 10, 12, 15%, and then one day it retraces everything. It comes all the way back down, and you start seeing violations, especially if there's high volume back in. Very negative sign. You got it. That's a red flag. You start closing below the 20 and the 50. You start getting lower lows. As those pile up, you see at this point right here, you've now got 4 or 5 violations, and it hasn't really come off much yet, and then it starts to implode here. So that's why these are warning signs. Again, coming out right here, OLED. I actually bought this coming out of this little base here, and then you've got 4 lower lows, full retracement of the gain, high volume back in versus lower volume out, and you're below the 20 and the 50-day. So you've got 5 violations right here, right? That's enough to say, hey, I gotta reduce here.
That's
This
a
is
textbook egg too, Mark, just in terms of, you talked before about how you want to see things in new high ground in off ideally a fraction of the days it took you to get there. Here you have the opposite. You've retraced the move. It took you 8 days to, make a nice move, and in 3 days it wipes it all out.
That's right. The exact opposite of what we would want to see. So again, here, 4 lower lows. You got a failed, natural reaction. It was pulling back here, started trying to turn up and then failed. So the natural reaction started looking unnatural, right? Now you're below the 20 day. You got the 4 lower lows. It's just not acting right. Now you spend a bunch of time. Look how long it takes to make this little tiny rally. Comes up, it's only up from like 21 to 22 and a half or so. So it doesn't go up very much, but then very quickly, boom, comes right in and you're at lower lows. And you're getting 1, 2, 3 lower lows, 4 lower lows. Again, just not acting right. If you weren't selling some here, you absolutely should be selling it over here and really and running for the hills. Let's see here. Now, again, another thing to look for when you have pivots, if you have a pivot and it tries to break out of the pivot and then it comes and gets below the pivot, that's what we call a pivot failure. That's negative. That's negative, and now the stock is volatile. You're not getting that alpha, right? You want that alpha on the upside. The stock should be moving up, having very little downside. This is the exact opposite. We're moving down. We have no upside, and then the stock can't rally. This is another O'Neillism, if you will. O'Neill said, and I think he's actually said it in his book. The worst thing a stock can do is break and not be able to rally. The best thing a stock can do is break out. This is what I said, is the opposite. The corollary to that is the stock breaks out and doesn't pull back much. Or if it pulls back very quickly, it's back to the new high ground. So what just on the upside, the same thing works on the downside. If the stock breaks and it can't rally very much, that's negative. This is what we call a ledge. And this is actually a shorting setup that we use, where once the stock breaks and it has a base failure or a pivot failure, if it can't rally and it just goes straight sideways, that's a stock that you want to look to short. We actually put this on our short alert list right here as it went through the 200-day. This was Michael Kors. Another one here where, again, you see you come out here, you get a couple reversals on high volume, and now close below the 20. The volume's increasing, 3 lower lows. See, this is not what you want to see. This is the exact opposite. If you look from the breakout here down to here, we have the 3 lower lows. That is the exact opposite of what you would want to see. If you turn this upside down, you'd say, oh, well, that stock's acting great. It's the exact opposite, right? So, and then you form the ledge, and then the pain comes here even more. And look at the volume. The volume's coming in. There's big volume on the downside. Just everything is exactly the opposite of what you're looking for. So see, when you know what to look for, when you know what should happen, everything else is a problem. And then if you start seeing things like this, these are really negative things. These are a real problem because now these are red flags. So because you have that reference point from this point right here, where you go through the volatility contraction, your supply stops coming to market, you get the 1-2 punch, stock breaks out. That stock, if it's under accumulation, if institutions are in there backing up the truck, it should hold. You should get confirmations. If you're getting violations, it means one of two things. Either something's wrong with the stock or the market. It might be the company's in great shape, but the market is correcting and there's so much weight from the market that the stock can't hold up. They're selling everything. They're throwing out the baby with the bathwater. Again, here's another one, 5 below. I remember this one really well. It came ripping out here on a gap on earnings. And I was watching it the whole time while I was basing here, waiting to see if it could tighten up and get my VCP. And it did. It just came out on earnings. Then it tightened up here. All right. And it tried to break out. But see, it couldn't rally much. It just didn't. It tried to have that. It pulled back. It had a little bit of tennis ball action, but then it started rolling over. 3 lower lows. And they came all the way. You had 8 lower lows, just moved sideways here. Can't rally. That's exactly the opposite. It just turn this upside down, right? If you turn this upside down, that would look phenomenal, right? It means it would run up and then it would move, drift back for a bunch of days. And in one day, it would erase it all on the upside, but it's on the downside. It's the exact opposite. All right, this is going back to what Mark was saying, how I always say, look to the left, right? A one-way street. Think of being on a one-way street and traffic is coming from the left. So you always look to the left. When you go into a stock, you're going to look and assess the supply on the left side. this is a real skill. This is something that it's hard to quantify. You have to ascertain how deep the correction is, how close the supply is, and then the price action at various levels. And now when you're setting up all around the high, it's a lot easier because you're just looking at that one level. So here in this instance here, you've got this primary base here, and right here it tightened up pretty nicely here. Tries to break out, but look at that. Boom, comes in. That's not what we want to see. Comes back. Now it's volatile. It comes back up to that level, comes off again, and now here's the ledge, right? Breaks down, and now it comes off here, and it just falls apart. But take a look. Look at where it reverses every time it's at that level. It's clear supply that level. So what would you want to see? You would want to see tightening. You want to see the price tighten up around that level, because that would give you the indication. If you got tightness in price, let's just say, over here, right here, after you bumped up against this level a bunch of times, it tightens up right near those highs and the volume comes way down. Well, that would give you an indication that this supply that you're seeing has stopped coming to market. And now when it moves through there, I'm getting through that level, and I've got some evidence that supply stopped coming to market. Now I'm gonna step in and I'm gonna buy that stock maybe.
Mark, just to point out too, that breakout attempt, I played this one on that day, and you can just see this is clearly not being accumulated by institutions.
No.
This is why. Look at that reversal, and you don't need. I think I sold the whole position on that one day because it was just. When you reverse that much on big volume, it tells you, if there are institutions, they're selling it, they're not buying it.
Right. And looking left and seeing that there's some, over here, this is the areas where it reversed from here, it reversed from here. That doesn't mean that you don't buy because it's going into that area. It means that you watch carefully on how it acts when it approaches that area. And if it doesn't act right, then that's telling you that supply, there's still supply there. There's still selling or sellers there. So this was a stock that broke out here of a really perfect little cheat area, real tight. And the point here is that, first of all stocks are risky, and you got to be careful no matter what the stock is. But the real key is that the stock could look great. It could set up perfect. And because the market might be weak or there's going to be some surprise news, number of reasons. We usually won't know the reason until in hindsight. If you start to get those violations and you start hitting your stop, you got to get out. You got to get out. This stock went down 99% in just 3 months. And I've seen stocks, there was one called Future Healthcare. I think it was FUTR. It was in the 90s, like 95 or something. I was going to buy it. It was setting up, and I didn't buy it for whatever reason. I can't even remember. And the next day it gapped down. It gapped down 80%. It was a disaster. So position sizing, we're going to get into that later. That's one way that you mitigate some of that overnight risk. But when you get these clear cut red flags, you got to heed their warnings. Now, real quick, let's, just like I did before with the upside, with the confirmations, what do all the previous violations have in common? Same question I asked for the confirmations. One, every single one of them did not have follow through. There was no follow through buying. After they broke out, a mediocre rally attempt, and then they ran right into selling. They all had more down days than up days. They all had more bad closes than good closes. Instead of good bullish volume dynamics where you had volume on the upside and low volume on pullbacks and contractions, it was just the opposite. You had volume on the downside and you had low volume rallies. And they all had reversals. They all closed below the 20-day, the 50-day, soon after the breakout. And there was no tennis ball action. Like that example I showed you, if I said if you turned it upside down, it was the exact opposite. It was a tennis ball action going down. You turned it upside down, it would look great, but it didn't. The stock was an egg, and then it accelerated to the downside. So comparing and contrasting these, if you go back and you look at these charts, look at these examples, and then as you start trading, compare and contrast what the violations versus the confirmations, you're going to find that your best trades are going to have the confirmations. Your worst trades are going to have the violations, and you'll start to be able to see this and recognize this in real time. So with that, we're wrapping up here. I'm not sure if we're finished for the day or if we've got one more, but we are going to take a break. So we'll take a break here, and then I'll see you for the next section. All right. Thanks, Mark. Appreciate it.
Great stuff.
Yeah.
Okay, guys, that is the conclusion of the natural reaction section and the curriculum for today. What we will be doing is answering questions and answers live with Mark Minervini and Mark Ritchie in 15 minutes. That's 12:30. Mark does have a 15-minute timer that we'll put on here for you. And with that said, do email your questions in to bob@minervini.com. I will just share with you right off the bat here. There are more answers or more questions than we are going to be able to answer. It happens every year. What we try to do is get the vast majority of the most common questions that we ask or that are asked. So just be prepared for that. We do have more question and answer sessions available for next Saturday, as well as the live question and answer session. I do also still see some questions coming in about content we have yet to review. So some questions will be answered in the presentation itself. So let's get back here right in about 14 and a half minutes, and we'll get started with the questions for you guys then.